All right. Hello, everyone. Welcome to today's 10 Capital Network's Quick Pitch event hosted by Hall Martin and myself. Today, we'll be hosting a great webinar, coming in with some pitches from some great companies. Starting us off with Hall Martin, giving you a quick intro and background about 10 Capital Networks. So without further ado, Hall, if you want to take it away and give everyone a little bit of information about 10, let's get you started.
Great. I want to thank everybody for joining us today. Have another great round of presenters and looking forward to your questions in the audience. Before we jump into that, let's talk about 10 Capital. We help startups and investors connect for funding and want to welcome you to one of our 4 online events that we have each month. This is the Quick Pitch event. And with that, let's go to the next slide. So at heart, 10 Capital helps startups raise funding. We go through the process of helping them get their deck together, get the fundraise strategy together, and actually get out in front of investors. We also provide due diligence reports, analyst reports, and other tools to help with closing investors as well. So in short, we do the legwork, saving you time and money. Next slide. We basically work with 3 different groups of investors. We work with angels and angel groups. We work with VC funds, and we also work with high net worth individuals and family offices. At heart, we form capital for the startup ecosystem. So with individual angels, we're helping connect to startups. With angel groups, we're helping them find members. With high net worths, we're helping them start family offices. And with VC funds, we're helping them find limited partners through family offices. So we have a series of events that fosters this ecosystem. Next slide. So we're in the quick pitch session today. Each company will get 10 minutes to pitch, 5 minutes worth of Q&A, questions from the audience as well. We also do 3 other events. We do the Family Office Roundtable. It's a 2-hour event that talks about topics relevant to the family office. We get a lot of family offices wanting to go online and do the virtual family office structure, so provide content and programming around that mostly. We also have a Life Science Syndicate event, just like this one, but for life science companies. And finally, we have a new one coming up that's called the Investor Education Session, where every month we have one session that talks about an educational component for investors on how to do startup funding and investing. If you want to learn more about the events at 10 Capital, go to 10capital.group and click on the events button, and you'll see all the events that we have coming up. Next one is, if you're a startup in the room and you want to join our program or consider it, please take a picture of that QR code with your phone, fill out the form, and we'll follow up with you to see if this program is a good fit for your fundraise. Looking forward to talking with you about how we work and what we do. We've been doing this since 2009. We've had over 780 companies go through our program since then. We have helped companies raise over $1 billion since we started. So with that, let's go to the next slide. We've also have a program called Investor Connect. It's a podcast program in which we interview angel, VC, and family offices about what they invest and how they invest in the early stage. We've taken all of those and put them into a chatbot called Ava, and we're building our own private LLM from which we can build due diligence reports and analyst reports as well. And we also have what's called the Startup Funding Espresso. It's a 300-word micro blog post that we write one a day, every day for several years, and it talks about a topic related to startup funding and investing. We now have over 2,000 of those, and in bringing them to the market, found it was a dilemma of how do we distribute it. When AI came along, the answer became clear. You put them inside an AI chatbot. So you just ask your question, and it scans all of that information and gives you a synthesized answer. So let's hear more about it with the Ava chatbot video.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. With that, let's go ahead and meet our presenters today. Our first one up today is Avergy. If you guys could go ahead and launch your slides and kick off when you're ready. For those in the audience, each one gets 10 minutes to pitch, 5 minutes Q&A. For those in the audience, please put your questions in the chat box or the Q&A box, and we'll read those out and answer them as we go through. With that, guys, we'll let you go ahead and kick off here when you're ready. We see your screen.
You see my screen? You can hear me. Okay, perfect.
It looks good.
Okay. Well, every minute, 70 airplanes take off, and leaving a trail of carbon in their wake. Aviation is one of the hardest sectors to decarbonize, and yet it accounts for over 2% of the global greenhouse gas emissions. But what if flying could keep connecting us without having to cost the Earth? At Avergy, we're working to turn this vision into a reality. We're on a mission to deliver scalable, high-impact solution for the aviation's carbon problem. By combining expertise in aviation and chemical manufacturing, Avergy is powering a clean fuel future today. Okay, so the challenge here is clear. Aviation is on track to double its carbon emissions by 2050 if nothing changes. Now, technology developments and operational improvements will help, but these are things that take decades to scale. SAF is a solution that can be implemented today and is the most effective strategy to achieve the net zero goal aviation has set itself for 2050. But what is SAF? Okay, so SAF is a non-fossil fuel that can be used in current aircraft and operated in current airport infrastructure. It offers up to a 90% carbon reduction, and it's a technology that's already proven. It has been used in more than 800,000 flights already. Many airlines are committing to at least 10% use of SAF by 2030, with growing targets over the next 2 decades. And yet, the production being supplied today only reaches 0.5% of the fuel needs. So scaling SAF is the key challenge here. By 2030, it's expected that in the US, there will be a need for 3 billion gallons of SAF, which it's equivalent to a market of $21 billion. And it will continue to grow at a rate of over 7% over the next 20 years. And yet there are many barriers to scale SAF. Among them, the high production cost, limited sustainable feedstock, policy uncertainty, and technology risks. So the SAF being produced nowadays is based on used cooking oils through a process called HEFA. Now, there are several problems with this feedstock. For starters, it's scarce. It depends on imports, and it's bound to hit its limit around 2030. So the future is in some other feedstock here, with needing some other technology too. We're targeting to use woody biomass, since it's a non-food biomass, meaning it doesn't compete with the food industry. And it opens a pathway that will also allow to use hydrogen, green hydrogen, specifically once it becomes economically feasible using the eSAF. So in this graph, opening the market to both the blue and the light blue sectors. So Avergy is in a unique position, offering a low cost and cleaner SAF through the combination of a feedstock, through a combination of feedstock and technology that few others can operate at scale. By using two independently proven technologies, gasification and Fischer chops, we will be turning woody biomass into actual fuel. And this will allow us to unlock a carbon reduction potential of over 90%, which is around the highest possible in the market, while maintaining a low production cost. So I mentioned a lot about the feedstock. Why woody biomass? So the US is producing over 30 million dry tons of waste biomass every year, which is equivalent to, which could be transformed to 2.5 billion gallons of SAF, which is around 10% of the market. So we have made the strategic choice to use this feedstock and locate our plants in the heart of the US wood industry in the US South, where we will be able to leverage high availability of feedstock and proximity to major airports. So what have we done so far? With the help of pre-seed money, pre-seed funding, we've been able to run pre-feasibility studies and engage with technology providers and potential customers. On the commercial side, we've been having some market traction on the Latin American airline niche, where many airlines are concerned about mandates being enacted in their countries where SAF isn't being produced either. By engaging with key decision makers, we have already gotten 2 letters of support from LATAM Airlines and Volaris, and spoken with other airlines like Golden Sky, who have demonstrated strong interest in the project. On the technology side, last January, we partnered with 2 major technology providers, GTI Energy and Velocis, to do a DOE grant application that would allow us to build an integrated biorefinery at a demonstration scale. Now, the DOE grant decision has been postponed, and it's at risk. Yet, it's been an invaluable experience for us, allowing us to validate our approach, align technical priorities, and solidify the foundation of our strategy. Well, all this has been pushed and achieved through a team of experts in aviation, energy, engineering, and project management. While the founding team offers a lot of experience in aviation, Project Director Brent Napton brings over 30 years of experience in energy and project management, while Technical Advisor Bruno Cateni offers a deep expertise in both gasification and renewable fuels. Together, we have set a clear pathway or a roadmap. We will begin with a demonstration scale plan, which will allow us to deliver SAF to our customers by 2027, while reducing the technology integration risk. Then we will continue with our commercial scale plant, which will be operational by 2030, and with a capacity of 10 million gallons of SAF a year. By 2034, we expect to have our second plant operational, allowing us to capture over 5% of the $7.5 billion US South market, SAF market. So yes, now we're looking for seed investment to achieve our next milestones. The seed investment will be divided into 2 tranches, offering first movers some financial incentive. For the first tranche, we're asking for $650,000 on safe notes based on a pre-money of $6 million. The funds from this round will be used to run feasibility analysis, some engineering design, plant location studies, and other operational expenses. So SAF offers a very attractive market opportunity with a high growth potential and a very profitable business model. We expect our initial revenues to get in by 2027 once our demonstration scale plant is in place, and to achieve positive cash flow by 2030 with our commercial scale plant. Over the next 10 years, the project is expected to have a return rate of over 47%. And the returns are not only financial. Avergy brings significant environmental benefits. Over the next 10 years, we expect to reduce the amount of carbon equivalent to 10,000 long-haul flights from New York to London, or the amount of carbon absorbed by 18 million tree seedlings grown up for 10 years. So in summary, aviation is urgently needs creating a great market opportunity. Avergy has a scalable solution based on improved technology and local sustainable feedstock. And we have put in place the right team to make it happen. So thank you.
Great. Thank you guys for a great presentation there. First question up is, who are the main suppliers of wood biomass? If it's the forest product companies, have you approached any such as Georgia Pacific, who's in your backyard?
Yes, we have. Maybe Brent, if you want to answer a bit about it, but yes, we.
Yes, we have had several discussions with Georgia Pacific. They have the largest lumber mill in the South in Pineland, Texas, in East Texas. We also have had discussions and a pending MOU with Weyerhaeuser. They have a very large lumber mill in Southeast Arkansas. So those two, we've had very good discussions and pending MOUs in place, as well as approval to take samples and test from their feedstock so that we can get the characteristics of the feedstock for our engineering effort going forward.
Great. Next question is, what is the regulatory requirements to bring one of these products to market?
So there's a, let's see, there's the pathway. There's several already proven pathways. Among us, the gasification Fischer-Tropsch is one of them, which is approved to use up to on a blend with regular jet fuel or fossil fuel jet fuel, up to a 50%. So today is 50-50. It works to move to 100%, and there's already been tested with 100%. It works. So there's that part. And yet, once we have the fuel, we still have to go through an approval process, which for an approved pathway normally takes around 6 months to get it. From what we've seen, for not approved processes, it takes years. So that's why we are focusing on an approved process with an approved feedstock for now.
Great. Next question is, you're asking for $650K. What's the valuation on that?
Yes, so we're doing a pre-money of $6 million on that. So 6,650,000.
Great. Next one is a question. Georgia Pacific also has a VC arm through Koch. Have you talked to those guys yet?
No, we think we're a little too early in the process to go with a VC offering, but we would definitely consider that in the future as we get further funding and develop this project.
What value would you find from or would want from a corporate VC like that?
Francisco, do you want to?
You mean monetary value or support value?
Either. Yeah, those are the two options.
Either.
What works for you guys?
Yes. No, I mean, of course, the monetary value always helps, but more on the support value. I mean, some strategic partner like them would provide. Well, first, it would secure the feedstock. The feedstock availability, which is essential for this to work. On the other side, it will help us have a technical backer that can. How to phrase it? Would help us make it. I mean, it would give us more. I can't get the word. Sorry. But it would make us more believable. That's what I'm trying to say. I mean, it's more reliable, more believable to have especially a big backer like them.
Great. Next question is, you have a contract with Latin America Airlines or agreements at this point. Can you talk more about that?
Yes, of course. So, well, like we said, we started engaging with Latin American Airlines. We know they fly a lot to the south, since it was our general location. and we have some experience and previous network builds with them. That was our selected niche to start with this. The main big changes in Latin America today are Brazil and Chile. They're about to enact mandates. They're on the way, and there's no SAF being produced there. There are other renewable fuels, but it's not easily transferable, especially at scale. So yes, these airlines, as part of the mandates, they're being allowed to buy in other countries. And they're looking to the US, and Europe for the production that is happening there.
Right. Last question is, what's the patents you have filed at this point, and what do they cover?
And so far, there are no patents. Like we said, we're engaging technology providers, so the patent today is on their side. On our patents, the technology patents would come mostly on the integration side. So there's a lot of, like I mentioned, there's our main two technologies are gasification and fischer tropes. Those are provided, but we have to combine them. So there's all the pre-processing of the feedstock that we have to make it work. Then the gasifier turns wood into gas, into a syngas. That has to be cleaned, so it goes through several filters and other processes to get to the carbon monoxide and hydrogen that you need. And then the fischer tropes unit will convert that syngas into crude fuel. And then, well, you convert it into SAF, and you have other gasoline and other things as byproducts, no?
Great. That's our 15 minutes. Thank you guys so much. Great presentation. Great questions from the audience. Appreciate that. Our next presenter is going to be Dopple. Lisa, go ahead and launch your slides and kick off when you're ready.
Okay. So hold on. Can you hear me? I don't see
Yes, we
my
hear you
screen
fine.
share capability.
Usually in the bottom center of the screen.
Yeah, no, I know where it normally is. It's not there right now. I have chat, video, participants, raise hand, more, and in the more I don't have, oh, in the more I have share. Here we go.
Yeah, they hide it in the more sometimes.
Okay, we're good now. Okay.
See your screen?
Yep, let me go into presentation mode. We good?
We're ready to go.
All right. Welcome, everybody. My name is Lisa Marino, and I am the CEO and founder of the Dopple. So when you think of Dopple, we're a fintech platform that helps families fund what they need. At the end of the day, when you find out you're expecting, there's joy from being excited about having a kid, but it's also complicated by an overwhelming question. How are we going to pay for all of this? And it can be overwhelming for families, particularly if you're middle and lower income. Did you know that the average cost per child per year is over $17,000 per year? And that's just to cover the basics. You've also got situations where over 135,000 families each year are pushed below the poverty line simply from child care expenses alone. At the end of the day, there are funds to help families get through, but they're difficult to access, and it's a highly fragmented environment. For example, over 2/3 of the federal dollars allocated to middle and lower income families that are on an annual basis are actually not used. And so we're trying to connect those dots in a way that help families fund what they need most. So enter our platform. Dopple is a patent pending platform that turns gifts into real world financial support. Think diapers, daycare, medical bills, college savings accounts, whatever families actually need. They start by building a needs list. Then we aggregate funding from multiple sources. So friends and family, potentially your employers and benefits providers, grants, government funds, philanthropic dollars, making financial support seamless and accessible. We sit at the nexus of three huge markets: the $1.7 trillion gifting market, the $650 billion care economy, and the $1.6 billion crowdfunding market. Each of these markets have CAGRs over 10 to 15% per year. The issue is these industries are either outdated or haven't really evolved to meet the needs of modern families. And so our solution really disrupts these markets by helping families rethink how they fund their basic needs. Let's talk about our competitive environment. We differ from our competitors largely because we take responsibility for the entire transaction, from funding through payment of the service or product. We have to because of fractionalized gifting, which is a core piece of our technology that we've applied for the patent on. Further, when you think of baby registries or wedding registries, the registries and or the Walmarts of the world on the retailer side, they really focus on selling stuff in a single transaction, whereas we're really looking to organize a family's ecosystem. That ecosystem of support that help them get really what they need at a price the gifter can afford. So if I need $1,000 diaper subscription as a family, that's a pretty daunting item for most gifters, since the average gifter contributes $25 to $100. But if I, as a gifter who has a $25 budget, can just contribute whatever I can to that diaper subscription, now I'm helping the family get what they need, and I'm honoring my own budget, feeling good about what I'm providing. On the crowdfunding side, we definitely have a better solution than what they're offering, because they're largely cash accounts with no accountability at the gifter or donor side, so you don't really know what the family's doing with the money. And last, on the marketplace environment, these marketplaces do a great job of matching buyers and sellers, but they can't handle the gifting of things, and there isn't the ability to aggregate different funding sources. So now let's talk about how we make money. We basically two-sided transaction. So today, existing registries make money from advertising and from affiliate revenue. We make money from transaction fees from the gifter plus affiliate revenue. So it's very different than an advertising model. And the reason we have to function that way is because we're taking responsibility for the transaction. So if a family adds, $1,000 worth of childcare to their needs list, we will take 5 to 7% from the gifter, and we will take 5% from the childcare provider as well. And at the Dopple side, the family never pays unless they choose to. Sometimes, let's say your $1,000 childcare fund only has $800 gifted. The family may choose to fund the other $200 to complete it. Now let's talk about our traction. So we've had some great early traction with families. Most of these families want less stuff and more help. So we've got strong GMV for a birth wish list and for what we call a birthday wish list, so a standard event. The birth wish list has a GMV of over $3,500, and the average event wish list has a GMV of over $1,200. For the birth wish list, we saw 85% of the people who came in as a gifter converted to a buyer of a gift at an average order value of $148. So the LTV of these wish lists is very high, and our ability to bring customers in repeatedly is also very high because we scale with the families as they grow. So let's talk about our use of funds and what our ask is. We've got some really great traction, and the most interesting thing that I want to bring up, which is very recent, 2 weeks ago we got a commitment letter from the state of New Jersey, and they're going to match $500,000 of our angel investments that are coming in right now. We're really excited about that because not only do we have the money coming in, but we get access to families, to service providers, to hospital systems, to people that can really build out a pilot in New Jersey for what we're proving. Our ask is $1 million between angels and WeFunder. We've got 100K already committed. Terms are very simple. It's a standard preferred stock, Series Seed, 1x pref, $7 million pre-money. Let's talk about exit strategies. So we're really sensitive that angels want optionality when it comes to exits. I've heard a lot that people's money has been tied up for years. And so we really look at exits in three different buckets. The first one is about a year after we've achieved profitability, and we'll be going out and doing secondaries, potentially management buyouts to help drive some liquidity for early investors. As we hit certain milestones and bring on additional funding sources, we think there's going to be inflection points every couple of years. And over time, the number and the types of companies that become interested in us expand. And that's what we're really excited about. By the time we've got all the funding sources implemented and we're in multiple states, we think we become interesting to a variety of companies, in particular, the employment and benefits companies. Obviously, PE firms are interesting given the cash that we'll be generating. And then family-based CPG companies, I think, are also a sweet spot for us. So think Johnson & Johnson, Kimberly-Clark, people doing a lot of diapers, people needing access to families. Management team's been together for 13 years. We scaled our prior company, RockU, from 15 million to 150 million very profitably. And from an expertise perspective, we really are focused on, or our strengths lie in e-commerce, tuning, and the mom market in general. We did sell RockU in 2018. I also sold my last company to McClatchy Media, in January of 2024. They are the lead investor in this round, along with the state of New Jersey. So there's a great track record of support from that organization. Let's talk a little bit about our financials. There's 4 key takeaways from this slide. First of all, in 2024, we did $1 million of revenue, and we're beginning to scale that. Over time, revenue becomes very diversified, which I think is attractive, between products, services, and subscriptions. So we've got a really strong mix across all of those, across the spectrum, serving families across many different options, right? And then the last piece is around recurring purchases. So we've talked a lot about diapers and to some extent clothing purchases. These recurring items are prepaid upfront. So we're collecting the money for a 12-month diaper subscription at the time of the gifting window, and we deliver against it over time. So we generate a lot of cash in this business model, and then we honor the liabilities over that 12-month window, for example, at a very nice margin. So, that's this opportunity is both financially very sound, but does a tremendous job of creating social impact, which is also very exciting for us. And that's Dopple.
Great presentation. First question is, what's the use of funds?
So use of funds is threefold. The first is really product, right? So we need to keep expanding the platform, particularly as we bring on additional funding sources. The family side, which I consider the demand side, is fully built out. And today, on the funder side, we've got a very robust platform for friends and family. We've just partnered with a company called Starlight to bring on federal funding. So that will be rolling out sometime in July or August is my guess. We don't have a firm date on what that will be yet, but that third-party partner is going to be able to pre-qualify people for federal funds for childcare, for SNAP, for rental payment help, and for utilities. We can use that pre-qualification also for philanthropic dollars, which is super exciting. And that gets me to the second use of funds. We are allocating 10% of this raise to what we call Dopple community gifting. So we're going to take 100 grand and we are going to go prove out the philanthropic model using our own money. So we're going to focus on families who've got needs for diapers, childcare, and college savings accounts. And we will use our own platform to pre-qualify them in the state of New Jersey and allocate the funds accordingly. And then the last use of funds is marketing, right? We've got to bring families into the system.
Great. What kind of network effects or virality do you have in this model so far?
So when you think about building a needs list and the fact that we encourage families, whether it's a birthday, whether it's a birth, to invite their friends and family to gift, particularly when we're dealing with birthdays, you've got an opportunity. Let's say your kid's 5 and you invite all the kids in the class, which is a very common happening. When you send out that invite to 15 other families, right? Because the average birthday is going to have 15 to 20 attendees or invitees. I'm inviting people who look just like us, right? They've got kids who also have birthdays. And if I can just convert one of them into a needs list creator, now we've got a great opportunity to grow virally. And that's exciting for us. We also partner with service providers and hospital systems to bring us families as well. So we've got really efficient user acquisition across the board.
Who do you think is most likely to acquire the company?
Yeah, I think in the long run, I think there's 3 acquirers. Because of our financial model and the cash generation, I think PE is going to be kind of the low-hanging fruit, no-brainer. That's much less interesting, but that's the safe bet. I think in the long run, the people who want access to families like the benefits programs and the CPG, the family-based CPG providers, right? Kimberly-Clark, Johnson & Johnson, those types of companies, I think we fit squarely into what they do.
Great. Can you talk about your relationships with partners like Walmart and the others?
So with them today, we're mainly just using them as a source of products that you can add to your needs list. And if those items get gifted to you, we just execute the purchase on Walmart or on Amazon and take our affiliate fee.
Okay. Well, great. Well, that's the end of our 15 minutes. Thanks so much for a great presentation.
No problem.
Cool. So our next presenter is going to be Print3D. Lance, if you can launch your slides and kick off when you're ready.
Hi, I'm Lance Thurlkill, co-founder of PRINT Technologies. As you can see, America has a real problem. We are short 7.3 million affordable homes, and we are only building 1.4 million homes per year, of which less than 10% are focused on affordable housing. Construction costs are up over 30% in 5 years. The industry is stuck in the past. Meanwhile, people are struggling to find an affordable place to live. At PRINT Technologies, we are solving this problem by disrupting the construction industry. We're doing that by bringing automation, AI, and 3D printing to construction to make it more affordable, sustainable, and scalable. But before I tell you how I'm going to do that, let me tell you how we got here today. My family, several years ago, we lost our home unexpectedly to mold, and building the next one took twice as long and went 50% over budget. At that time, I knew there had to be a better way. And I couldn't help but think, if it's this inefficient and expensive for me, how much more impactful is that to people that are struggling to find an affordable place to live in the first place? The reality is the system is broken. And when there is a broken system, there is an opportunity for innovation. That's why we built Printed Technologies, to solve a real market failure. Here's my co-founding partner, Craig Pettit, and myself standing outside of one of our 3D printed homes. My family's been invested with Craig in his residential real estate portfolio business for over 30 years. And in 2019, he bought a 3D printing machine to print homes for the portfolio and successfully printed the 7th and 8th 3D printed homes in America. As a third-generation owner of a manufacturing company that is highly focused on automation, I became fascinated with this concept. Through my experiences having built several homes, the inefficiencies were shocking to me. Coming from manufacturing, where precision and efficiency are everything, I was shocked by the lack of these principles in construction. That frustration sparked an idea. What if we could apply a manufacturing mindset, automation, robotics, and AI to disrupt the construction industry? I shared my vision with Craig, and he immediately saw the potential. We had the perfect combination of expertise, his real estate and construction background, combined with my manufacturing experience, to tackle one of the world's largest problems, affordable housing. So in 2023, we made our move. My company, All Metals Fabricating, invested $750,000 to match what Craig had put in up to that point, and we launched PRINT3D Technologies. Our mission is simple: revolutionize construction to make it more affordable, efficient, and sustainable. We're not just building homes, we're manufacturing and selling machines that will help builders everywhere embrace this new era of construction. So let's understand the opportunity. For over a century, American homes have been built the same way. Hey, and it worked. Wood framing, labor-intensive construction, it fueled expansion, supported growing families. But the reality is the system is broken. That American dream has slipped away. You can see that demonstrated here by this chart showing how rents have drastically outpaced incomes for decades. Further, home prices have more than doubled since 2000. Meanwhile, as I mentioned, wages simply have not caught up. Construction costs are up more than 30% in just 5 years, not including surges we're about to see from the tariffs. And the industry their solution thus far has been to use less skilled workers and inferior materials, which leads to a decline in the quality of housing. This slide shows that in just 10 years, the amount of people being able to afford a home has dropped from 50% down to 16%. This is a massive issue. And we have a solution. I don't know if you've ever seen a 3D printer, probably if so, at little desktop size. Well, now scale that up to the size of a house. And you have here on the screen our patented 3D printing home machine. And so you can see basically the way it works is if you think of a soft serve ice cream dispenser, it's like that, except it's dispensing concrete. And the machine moves on a gantry and is told where to go and what to print based on geometric code, which we'll refer to as G code from here on out. So what differences does our solution offer? First, we can produce a 20% savings for a wall system that far outperforms traditional building methods. Our walls are mold resistant, termite resistant, fire resistant, and hurricane and tornado resistant. This is particularly relevant as you saw the fires in California. There was one house left standing in Malibu, and that house was concrete. Same thing happened in Hawaii several years ago. There was one house left standing, and it was concrete as well. Granted, they were not 3D printed, but it's the same materials and the same truth of the fire application. So next, we can produce a 30% time savings versus traditional construction methods. Time is money, and with our walls, you're removing framing, sheetrock, masonry, paint, and insulation. With our future plans, we're confident, and with economies of scale as well, we're confident that we can expedite these times even more. Next, precision construction and reduces waste significantly. So the combination of proper planning and precise materials, along with the fact that our material has a lot more durability compared to sheetrock, this will drastically reduce landfills over time. Lastly, there's a big savings for ownership costs. So first off, energy bills will be lower because we have better thermal properties. Next, just the costs in general are much greater savings. The walls are much more durable. For example, in our rental portfolio, we have about an average cost of $600 between changeover tenants, which is drastically lower than the typical cost of a changeover between tenants. So what's our secret sauce? It starts with our partnership with All Metals Fabricating, which I own. It's a world-class manufacturing facility shown here in the picture. This vertical integration gives us complete control over production and allowing us to cut costs on our machines. And this is demonstrated by the fact that our cost basis on a machine is $175,000, with the most comparable option on the market starting out at a $1 million sales price and goes up to about 1.5. Equally as important, this partnership allows us to scale up production to meet any amount of demand that the industry could create for printers. So we could manufacture hundreds of these if we needed to in a month at All Metals Fabricating. Next, combining our real estate experience with a data-driven insight and approach will allow us to streamline construction nationwide. Lastly, because of our partnership with All Metals Fabricating, PRINT3D has inherited 70 years of experience in manufacturing an efficiency mindset that is focused on bringing an efficient approach and automation to construction. So what have we accomplished? In 2019, we bought our printer. In 2021, we successfully printed the 7th and 8th house in America. 2024, or since then rather, we've built 5 structures, including a house last year for $100,000. We designed and built 2 of our second generation machines, which we have in stock. We achieved a top 10 worldwide rating for automate construction and a top 5 for 3D home printing. We developed an augmented reality app that allows you to walk through our homes virtually, which we look to leverage this technology further to train builders and trades on the homes. We renamed and rebranded the website, or the company rather, launched a website and a marketing campaign last fall. And then this year, we received our patents back on our design. We've developed a sales pipeline with $2.5 million in the pipeline. We've invested $1.5 million to date, and we recently won 3D Printing Company of the Year by Construction Tech Review magazine. Given all that we've accomplished, we feel confident in raising $1 million at a discounted $8 million valuation, and then a second tranche of $2 million at a $15 million valuation to achieve the following. First, we want to develop a proprietary software that allows automatic G-code creation from dropping in architectural renderings, whether they be 2D or 3D renderings. You will drop it in the software. It will automatically create the tool path for the machine to print. This will allow builders nationwide to use the technology to print whatever houses they want. It will also create estimates on the wall system. And equally as important, given that we're a technology company, this will create a SaaS revenue stream. Next, we're going to invest in developing a brick-style print head that will appeal to traditional architecture types. So currently you see the beaded method. We can either do beaded or a smooth wall finish. Our new style with a brick print style will allow us to do a more automated approach on the smooth wall or appeal to traditional with the bricks. We also want to develop a mini concrete batch plant, which will allow us to reduce our operating costs and get that 20% cost savings down to 30 to 40% per build. Next, we want to hire an R&D team to support ongoing innovation so that as we get into development projects and build jobs, our innovation is not slowed by construction jobs. And then lastly, we'll build additional machines to be able to take on large-scale development projects and have sufficient machines in stock to sell. So here's what we are confident are very conservative numbers. Honestly, the numbers for this year, the most aggressive. And these numbers are based on both us printing houses or structures and selling machines. So in 2025, that's based on 9 structures printed and 2 machines sold. 2026, 40 and 8. 2027, 75 and 24. And 2028, 125 and 48. Now, I will mention that market adoption by builders nationwide could drastically increase this demand, because we would increase, just for example, if we sold 20 or 40 more machines, we would have 20 more million in profit or in revenue and profitability. Now, in closing, I want you to imagine this. I want you to imagine an entire community being built by 3D printers, and what we call a house in a box showing up for a house with everything in that house needed, HVAC, windows, doors, to allow the trades to get in and out as quickly as possible. Then I want you to imagine a family like this moving in happily after just 3 months of construction at an affordable house, at an affordable price. And with this type of solution, we can change the trajectories of affordable housing. This is more than an investment. It's an opportunity to fix a broken system and transform the future of housing construction. We have the technology, the expertise, and the urgency to make home ownership more accessible while building a high-growth, scalable business. The need is massive, and the time is now. Join us.
Great presentation, Lance. First question is, what builders are you currently in partnership with or discussion to work with?
Historically, we've been the builder, so we actually have our builder's license, and we've built the homes completely ourselves. And we're currently in talks with a builder in Dripping Springs, Austin area, to do an 18-house development. We've got a bid on that, and we're waiting on an LOI.
Great. And for the long haul, what do you think is the difference between the revenue from selling the systems versus building the houses?
Ultimately, the opportunity is really from selling the systems, and that's also where you make the impact. So once municipalities embrace this technology, right now we're currently limited to rural areas and counties. And so that is really the path to profitability and impact as well.
And how many houses have you already built?
We have built 3 houses and 4 other structures.
And can you do multi-family structures?
Yes, we have plans. We already have construction plans for duplexes and a triplex as well.
Great. And can you tell us more about the team and their background?
Yeah, my co-founding partner, Craig Pettit, is the owner of Ready Mortgage. It's a mortgage and real estate business. And he's been building homes, flipping homes for 30 plus years. Kane DuPont is a home builder. He's our director of operations and also has a background in concrete, selling cementitious, high-end cementitious products. And we've got several other team members on the construction side with heavy construction experience as well.
Great. And tell
And
us
I
more about this.
myself have been a 2X founder. I recently founded and sold a company to NCAP last year. It was a alternative energy company.
Right. And can you tell me about the patents you have or in place for the system for building a moat around the business?
Yes, our patent is on our current design. It's our gantry-based system. And so our current design is under patent. I don't know exactly what specifics you would like to know about it, but I can speak to it further if more details are desired.
What claims does it make?
Oh, it's just on the design of our machine, the way that it operates. It's kind of the easiest way that I could explain it in layman's terms.
Okay, that sounds good. What about
And we do have that patent available in our vault. So if somebody wants to take a dig through it, I'd be happy to share that.
Great. And what's the exit strategy here? Who's most likely acquire and why would they buy you?
Yeah, I think ultimately, I think the long run will be an exit with one of the largest home builders or an IPO. And I think in the midterm, we would look for a private equity company to come in and give investors the opportunity to liquidate after 3 to 4 years, so that we could scale up and they could consolidate investors. But ultimately, I think the big play is in 5 to 7 years through an IPO or through an acquisition of a large home building company.
Great. And that's it for our 15 minutes. Great. Thanks for a great presentation. Appreciate that. And we'll bring up our next presenter. We have Shaylee from heyC. Shaylee, if you can launch your slides and kick off when ready.
Yeah. Hey. Hi, everyone. Thank you so much for taking time. I know it's evening on a Wednesday, middle of the week, so really appreciate that. I'm going to go and jump straight into what heyC is and what are we doing. So I can share my screen, right, Hall?
Yes.
Okay, perfect. So like I always say that, investors see a lot of presentations and there are a lot of great companies today. There are companies that are building printers, there are companies that are changing lives and healthcare. And then there is a company that'll make you feel like you're sitting inside a pastry. And that's what heyC is all about, okay? So heyC is creating the world's first AI coach for every teacher. In this world where there are vertical AIs and AI agents being built for different industries, my expertise and horsepower is in K-12, and I'll share a little bit about myself, but that is our journey of what we are creating. We started a few months back. We already have sales. Our product is launching. Districts are already hopping on. So there's a lot of traction that we've gained in the last 2 months. So a little bit about me. This is not my first rodeo. I'm a serial entrepreneur. This will be my 4th company. I've had 1 exit before in India. My background is I'm an industrial engineer, very focused on product design. My passion was K-12 teaching. So I got a K-12 teaching degree after that. I started a company called Elevate K-12 that landed up creating a category of bringing live teachers and streaming live teachers into K-12 schools, scaled the company to 40 million in annual revenue run rate, raised up to a Series C round of funding from General Catalyst. And then I kind of wanted to go back to the startup world. So we have a CEO taking the company to the next level at Elevate, and I'm back in the startup mode building heyC. I started heyC because I saw this massive problem in schools and districts where they're able to now hire teachers, but they can't retain those teachers. So I'm taking all the knowledge of what I know on how to build and sell in K-12. And I know a lot of investors are very nervous about selling in K-12, but if you do it the right way and build the right sales engine and are solving for a problem, it is an amazing industry because there's money sitting in the budget and competition doesn't creep in because people have to understand all the regulations and stuff like that to scale. We have all of those things going for us. We've built an incredible team. apart from me. And again, anything in AI is small, 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 tiny, tiny teams. Elevate K-12 at one point of time had over 400 employees and 100 engineers. We don't need any of that for this one. This is going to be a small build because it's an AI build. My COO who scaled Elevate K-12 with me is a serial edtech operator, has had multiple exits with other private equity funds. I launched this with her. Jin Huang is our CTO. He has been working with AI for the last 15 years. He's not trying to figure out now because we know that any company that's building an AI agent, the first mover advantage is very important because you're the one, when I think about the flywheel, it's us as a company that honestly will be the first one launching in the market to build all of this data, but is also the first scaler advantage, and you got to see your flywheel moving. Apart from this, I learned from my previous experience, having advisors is very important. Head of Core AI, Microsoft, good friend of mine, Jay Parekh. I met him through my journey of building Elevate. He is advising us on our AI strategies, and there are several superintendents involved as well. What is the problem we are solving for? Just think about it. Around your life today, how many kids are trying and dying to be a teacher? Very few of them. And the ones who are actually going into the teaching profession, they enter into the teaching profession and they have to do so many other things apart from just teaching that they are frustrated and leaving. So, an old school teacher would stay for pensions, but a new age teacher wants wellness, wants climate, wants support, wants to feel empowered. They want to give back to the society, but there is no way for them to do that. Even if you see beyond the new age teachers, half of them are quitting in the first 5 years. But even in the other stages of teachers, there's high attrition, and all the reasons point out to lack of support in the school districts. And school districts know that in today's age where everything is at the tip of your finger, they have to be able to provide support to teachers at the tip of the finger. They're not able to do that because with humans, it's almost impossible to scale the support system for all the teachers. And what the districts are doing today is workshops and monthly PD and annual PD and quarterly PD and spending ridiculous amount of monies and not getting the return that they want because the teacher attrition and attrition is high, satisfaction is still low. That's where heyC comes in. I started thinking of this concept last year when I stepped down as my role as CEO at Elevate K-12, and I started looking at what is the next big K-12 problem to solve for. This is not going to be my last company. There'll be another K-12 one, but today this is what I'm focused on, which is how do we provide on demand, on target, fully on support to every teacher. Without AI, this would have not been possible because having one human support every teacher is just not scalable and too expensive. So, what does our AI coach do? Our AI coach is, of course, an AI. They are experts in all things K-12. They look and talk and feel like a human coach. They're available 24/7. They're cool. New Gen loves it. In this world of AI agents, where there are AI agents everywhere, whether it's Harvey AI or whether it's AI Companion or Decagon AI, what does that mean for the K-12 profession to bring efficiency in the industry? That's what heyC is all about. heyC will help the teachers with a lot of things, but the most important thing is to provide coaching and support. And what are they going to provide coaching and support in? How to teach a concept, which they all learn in their student teaching programs. How to manage a classroom. Every quarter, there is a different scenario in today's day and age where classrooms are evolving. How do you communicate with parents? My own professional learning. I want to become a better teacher and a teacher's executive assistant. Apart from that, the reason I'm calling it a coach and not an assistant is non interactive. Do this task for me, do this, add this on my calendar. A coach is interactive. So, the way we are building our AI algorithms and models, it's an interactive coach where there will be dialogue between the teacher and the coach will hold the teacher accountable. These are just some screens. It's hard for me to explain what we do. I don't think I have enough time to play this video, but I'm going to quickly jump to showing a little bit of the video. Are you guys able to hear it?
To build a better world,
Yes, we can.
we must empower those who build its people. However, a stark reality confronts us, an alarming into nurturing the potential within us all. Introducing heyC, world's first AI-powered tool designed to deliver a personal AI coach and chief of staff to every teacher. heyC supports teachers with classroom challenges, acting as an expert, provides career guidance, and helps manage daily tasks. It also provides accountability, motivation, and goal tracking, acting as a true partner and coach. Getting started with the app is easy. Simply answer a few questions, and heyC will match you with a selection of coaches tailored to your needs. Choose the coach that best aligns with your vibe, whether you prefer the high-energy motivation of Chen or a supportive and easygoing approach of Clara. Let's pick Clara and see her in action.
Hello, I am Clara, your personal AI coach. I will be working with Susie today.
So I can't show you the whole thing because I have a deck to finish, but I'm going to share this with you so you guys can continue to see it at your leisure. And what I'm doing, I mean, all of you have seen these ads of Meta where voice AI is starting to become very dominant. Like people are walking and talking and interacting with voice AI. Once you see this deck, have a look at it. This is the norm of the next version of how AI is going to have coaches and companions. How are we building this? This is the most important thing. We're building it on top of GPT 4.0 and other LLMs. But our horsepower comes in our deep domain expertise in K-12 of me, our COO. We have several school districts that have already partnered with us and district leaders that are constantly curating our content to make sure that we continue to build our horsepower. Not just that, this is a very regulated industry. What that means is that just like law and what Harvey AI did, what works in Florida will not work in California. So we are building our foundations and technology maps in a way that if we go to a school district in Texas, the Texas state bylaws, regulations, policy, curriculum, then at the local level and at the district level, all of that is curated into our platform. So when the teacher has a question to the coach, the question is answered correctly. Huge market. $16 billion at the state and local funds is spent every year just on professional learning. We will be venturing into other markets like selling to universities and private schools. My experience is selling and nailing it at the K-12 level in the school districts. I'm just starting with that right now and being conservative. The president 3 weeks back just signed the AI in Education Executive Order, where every school district is going to get a specific grant, and there's a grant for using AI for teacher training. I was shocked to see that, but it is another feather in our scale of how fast school districts are going to adopt this. The best part of how cheap it is, at $84 per year per teacher, that is 2 Starbucks coffee a month, a teacher gets their own AI coach. We're selling to the school districts, so we're selling at the enterprise level, but the users are going to be teachers. We just kickstarted our sales a few weeks back. Again, Elevate sold to 600 school districts. We have all of that expertise of how to reach out to these superintendents. We've already booked $140,000. We are on track to crush $420,000 by early July. That is just our pilot. We're not even doing free betas with the school district. Conservatively, I'm not trying to tell you that I'm going to become a unicorn. Absolutely not. I'm being very, very thorough and conservative. Just by raising $3 million in seed right now and $5 million later in 2026, I will get to $34 million in annual revenue run rate. That's my jam. And then we can decide, like the .com era, I think AI companies are going to get gobbled up. I have no desire to do an IPO in this yet. The goal will be, let's build something great and let's see what the right exit will be for investors. We have a very solid pipeline, not just for the upcoming July. School cycles are longer, so we're starting to build for next school year. Next school year by July, our goal is to book $3.8 million, and we're already building a pipe for that. Lots of things going on, lots of funding going into AI assistant K-12 companies. Companies that started 1 year back or 1.5 years back are now doing their A and B rounds because there's so much money flowing into AI education. Because unlike other companies, K-12 school districts can't build their AI tools. They have to collaborate with private companies to bring any kind of innovation. We are currently raising a $3 million seed round. We already have 600,000 wired. It's today a note of $10 million valuation cap. I'm expecting a term sheet to come anytime today or tomorrow. If the term sheet comes in and the terms are good, it will be a priced round. If not, then it will continue to be a $10 million cap. Exit from my side, I'm looking at a 2031 timeline. This is not a 10-year or a 15-year play. For angel investors, it's an exit in 5 to 6 years, if not sooner. Usually, K-12 companies are bought by large private equity firms, or they are bought by large K-12 companies, and that's going to be our focus as we scale. Today, K-12 companies are trending at 10 to 15x on the top line in terms of their valuation. That's what we're building. We would love for you to be a part of this journey to give every teacher an AI coach in their hand.
Great. First question up is, where do you get the data to power your AI system? What's unique about it?
So, like I said, the first part is the basic LLM. That's the content. So, more than data, it's the content of we have to make sure that by this time next year, our coach is giving the best answer compared to any LLM, any tool, or any human coach. So the basic is the LLM. Then we have a bunch of K-12 experts that are curating content in different categories. When you look at our data room, a bunch of our teacher interviews that we did early on are there. So we have experts curating content, but on top of that, as we went out in the market and started, collaborating with these districts, it's very important for us to give them the customization and the niche to upload their own content, which is their state regulations and policy, the district's curriculum guides, and then the local and county guides. So it's a mix of K-12 experts and that. When we partner with these districts, the feedback loops that we're making and how we are implementing RAG is very important. How are we modeling the coaching style so the feedback goes back to our AI coach for it to continue to get better before it goes into the early majority launch by next year.
And how would you describe your beachhead market? Who are the first 20 that are going to go jump on board with it?
The first 10 always have to be innovators in the market adoption cycle. These are superintendents that I know personally, or my VP partnerships that I've hired. I've built enough companies to know you can't wait. If you're confident about what you're launching, you got to start thinking about your sales, because you can build a product, but if your flywheel does not move, it doesn't make sense. So the top 10 school districts for the pilot were curated and selected, handpicked by me. So 2 in Georgia have already signed up. I'm going to Shreveport, Louisiana tomorrow to meet with Caddo Parish. We have Indian River County in Florida already about to sign up. All of these districts are superintendents that are innovators and thought leaders in their state. Like in Texas, we have 2 school districts signing up. Lancaster ISD in Dallas and Pflugerville next to Austin ISD. Both of them are already on board. Which is going through the legal contracts. So the top 10 have been selected as customers who are willing to collaborate with us to give feedback, because training our models is very critical at this time.
Right. And what's your distribution channel to market? How do you access all of these schools?
I mean, there's a whole system. I don't have enough time to say that, but nailing the distribution channel to school districts is the most important thing. So there are 2 ways to do it. The most important is lead generation. How are you thinking about the enterprise funnel? Lead generation in the K-12 market. Initially, for the first 3-4 months, we are focused on certain states, but we are going to get to all states by early next year. Like we just realized that last week, that it's very important for us to scale that. One kind of lead generation is through thought leadership. So we already have 3 superintendents who are going to talk about this category in the key conferences. We know what those conferences are. The second one is lead generation through the SDR MQN funnel, which I nailed at Elevate K-12 when we scaled from 0 to 40 million. Those same principles are going to come in here. For the first 1 year, we are going to sell only to superintendents of school districts with less than 50,000 students, because these superintendents have the power to take the call. It's not like I'm going to Houston ISD in the first 1 year. Houston ISD and all of these large school districts will come after a couple of years when the product is more proven out and large school districts are able to take it. From a sales strategy, we will have regional salespeople in the regions, just exactly like I did it at Elevate, but we are going to have a very focused inside sales team, because the contract sizes are smaller. They will be about $100,000, but they will be recurring revenue. So our cost of acquisition is very important for us to manage. So to make sure that my CAC to LTV ratio is managed, there will be more inside sales and brand development, but it will still follow a typical enterprise sales model.
Great. And that's our time for the section. Great presentation. Thank you so much. With that, we'll move to our final presenter, Chris at FIntegrate. Chris, if you'd like to launch your slides and kick off when ready. Got your deck there. You're on mute.
Yep, I moved my mute button. Okay,
All
can you
right.
hear me now?
Yes, we can.
I'm
Go
Chris
ahead.
Bishop with FIntegrate Technologies. We are a company focused in Birmingham, Alabama, based in Birmingham, Alabama, focused on collections and recovery for credit unions and banks. We have a dispute management system as well for fraud, disputes, and transactions. Our history is really in automation and integration for fintech for banks and credit unions over the last 20 years. So the problem we've seen in the last 20 years has not changed. Banks and credit unions use a lot of outdated systems. They, believe it or not, can be used in 20-year-old technology to try to run collections and recovery systems and collect on invoices and bills, late payments, that type of thing. And even worse than that, with the increase in fraud and disputes, banks are still using credit spreadsheets. So they track, 12, 14, 1,500 fraudulent transactions and disputes every month by a spreadsheet, and then report up to the auditors and regulators and the board and the president, again, trying to use spreadsheets for that. So there's a real need in the industry for an automated system that processes both disputes and collections and recovery. We have 3 products in this space. The first is the collections and recovery system, Fusion CRS. It is a full-blown collection recovery system from pre-delinquency risk analysis all the way through the process to post-charge-off asset recovery, shadow accounting to help the banks really take advantage of the financials and everything along the way. Our Fusion DMS product is for dispute management. It starts with from intake through resolution and reporting. So if you have a disputed transaction, a fraudulent check, credit card, debit card, wire fraud, ACH, you can start, go on the bank's website, click to dispute the transaction, and it starts the process. There's a lot of regulation behind each one of these systems and these processes, rather, that are required by the feds and the OCC. We automate that entire process. We post the provisional credits to the core. We back them out of your account if they resolve the dispute negatively for you. We handle everything in an automated fashion. Our Fusion LRS is kind of the legacy, or the new version of our legacy products for data conversions. So we've had 2 previous companies that focused on bank M&A and data conversions, and we just got back into that same business here recently. So we provide automation and integration, and have done so for 20 years for all types of banks and credit unions. And in doing so, we're moving towards the AI model. So the automation, kind of the machine learning we've been used to do predictive analytics and analysis on both disputes, fraud transactions, as well as credit delinquencies. We're going to move towards some more agentic type processing automation using AI. Today, we serve the middle of the community bank space, which is $10, $15 billion banks and assets and below. We have a $200 billion asset bank, and we have a $100 million asset credit union. So we serve anywhere in that market space. But our real sweet space is the 5,500 banks and credit unions that are in that 10 billion and below space. So we have a really large addressable market, most of which have really old software or are still using spreadsheets. The ones on the left is some of our customers we have in both banks and credit unions today. Our customer counts in the center. Then on the right, that's the largest core processing banks for banks, core processing companies for banks and credit unions in the country. Several of those I've sold companies to previously. You'll see here in just a second. Several of these also resell our software and services today, or refer our products, because none of them have either a collections product or a dispute management product. Myself and my co-founder, Jason Alfano, have done this twice before in the same space with the data conversion product. Our Chief Growth Officer, Jeff Harper, is no stranger to startups and being successful exits, as he's done it a couple of times as well himself with his companies. And then Terry Nelson was the president and founder of Fusion, which is the company we bought the credit and collections product from. We've had 4 successful exits in the past with the companies that I've started. I've bootstrapped all of these companies myself, started them, grew them to 500 or 600 clients, and then sold them to either a public company or a large private equity. And with that, I'll introduce Ray Martin, who's going to explain the financials. He was actually one of the ones that acquired our last business.
Hi, I'm Ray Martin. I'm not part of the management team, but I am a founding investor in the company and helping Chris and Jason and Jeff out with doing a financing. And thank you for allowing us to present here. So, company's been growing revenues pretty healthily. We raised a total of 3.2 million. Management put in a million in equity in 2021, and over the last 3 years. Excuse me, we raised 2.2 million from friends and family, so 3.2 so far. And we've been able to get reference clients, make sure that the products that we have good product fit. We're out there in the marketplace, and we're raising. You can go to the next one, Chris. We're raising this funding to basically, if you see the uses there, we need to add some sales staff and some marketing support. We've got a big We've got a big TAM and a big CAM, current addressable market. And we got a great management team, but we need some soldiers to go out there and market to this large number of community banks and credit unions. We have a great product as well, and it's priced well. So we think we can do quite well over the next 5 years in terms of building a business here. I can just go back 1 second, Chris. So it's a $1 million note, $12 million valuation cap, 20% discount, post money valuation, 3-year term, 7% interest, 100,000 minimum investment, although we'll do less than that. Just before you leave, so we've raised 170,000. We've closed on that, have that in the bank. We have a $500,000 soft circle from a angel network group in Texas, and we've been referred to the Texas Syndication Network just recently. So we're getting there. We started in February. We're getting to our $1 million goal. We feel pretty confident about that. Okay, next slide, Chris. Thank you. So in terms of exit, there's really no secret to exiting fintech companies. I was an investment banker for many years in New York, and I mean, essentially at this level, you really want to get to 3 million in revenues or 5 million in revenues. Those are the break points. At those levels, there's a whole host of companies that want to buy you. There's large aggregators, there's competitors, there's people that have adjacent software that want your bank customers, they want your revenues, they want your software. Certainly the core processors and private equity companies. So there's no shortage of exits. The real task is to get to $3 million in recurring revenue or 5 million in recurring revenue, and then you get up to the kind of the 10 plus multiples. But so even if we put on a low multiple and you put $1 million in a convert in, and the convert comes in at the top of the capital stack, you've got a pretty good chance of getting a solid return on this, and maybe even do better. Last slide. So just to summarize, good revenue growth last 3 years, proven software. We got 95, almost, actually, I think we have 100 customers now. The software is sold on 5 to 7 year contracts. We're spending some money on additional AI expansion, and we'll do more of that in 2026. Management teams had successful exits. We got a really good addressable market, large, and we got a good product targeted towards it. Management's got money invested and our friends invested. And fintech M&A, we think next 5 years is still going to be really strong. It's been strong. We think it's going to stay strong.
Right.
Great presentation. For those who have questions, please put it in the chat box. My first question is, is there a data play or AI play here?
Yeah, so there's actually both and combined together. So as we process collections, payments, and recoveries and track the fraud going through maybe geographical or by bank size, there's certainly a play for that. Same thing with delinquencies. As you aggregate, the types of delinquencies, whether they're car payments, boat payments, house payments, you can kind of play those and provide a lot of agentic feedback to the end user in their process. And also the accounting system, the shadow accounting system, is really valuable to the banks and credit unions in helping them lower their loan loss reserves, which is the money they have to set aside to write off bad debt for next quarter.
Can I just add on the AI side? We've got some really high-powered outside consultants that we're working with who've put a plan together for us. And the whole idea here is we're bringing automation to banks to save them money in a lot of ways, and we can talk about that later. but it's really through automation. And we've got automation, which is, a SaaS collection of SaaS software applications. But what we really want to do is chip away at the human participation in credit collections and dispute management, so it gets to virtually zero. And that we think we can do that, with AI over the next 2 or 3 years, and the banks will be ready for it, 26, 27, 28.
Great. Can you talk about your competition? Who are you up against?
Yeah, that's a good question. So we've got in the two competitors in the dispute management space, really one that only serves the top 30 banks in the country, which we don't go up to that market. So they come out of like the Bank of America space. So they're not really a competitor there. In the other side is the another competitor in the very low end side of the market, kind of the low cost leader there that serves the very bottom. And so we're really focused on that the middle community banks and credit unions in the country. So while the one on the lower end may be a competitor, if they are, it's only on price. It's not on the product feature.
Right. And what's your cost of acquisition compared to the lifetime value?
So that's something we're actually working through now. We've having bought the company from the founder, we're trying to get some good metrics and good numbers in the system. We've got everything in HubSpot we're tracking. We're really starting to analyze that now. The DMS product came out 18 months ago. The LRS product came out in the fourth quarter of last year. And then the CRS product's been in the market for quite a while, but it's more those that are in the market are some of the older ones. So we really haven't gathered a lot of analytics data from there.
What's your distribution channel for sales? What are you envisioning there? Direct distribution, distributors, affiliates? How do you do it?
Today we have two salespeople in the marketplace. Last year we pretty much just had one for the first half of the year before we hired Jeff and brought him on as as the chief growth officer and part-time salesperson there. So, but our real opportunities are in the channel marketing partnership. These guys know us both. These companies that I listed on the right-hand side of the screen, they know us well. We're well respected in the industry, and they're referring our partnerships today or our products today. What we need is the first hire we're going to make is a business development manager to really go in there and run our products down deep in their sales organization.
And how challenging is the regulatory environment here that you have to work in?
So it's very challenging for the banks and credit unions, right? They're the ones getting fined and getting written up for not processing things. You're not having a system of record to show that they did do what they're supposed to in a timely manner. And that includes mailing letters, notices, posting credits to your account, calculating interest properly, monitoring accounts for reversals. Our system does all of that. And that's part of the play for the DMS is they love that piece of it.
Yeah, but there's no regulation impacting the company directly. We basically generate a tremendous amount of information and reports that make it easier for the banks to report to their regulators.
Yeah, we're not a tier one vendor. They're the direct lenders. So the state to state differences don't apply. They're not a third party lender. Banks and credit unions are not. So
what's an average contract value for one of the systems?
So for the CRS system, the annual is about $25,000-$30,000. The TCV on those can be $250, $300. We've had a couple that have been $500 for the DMS product. That's probably more in the average salary, $60,000 in TCV for that one. Then LRS, having just started that fourth quarter of last year, but done it for previous companies prior, we kind of know what that can grow to and how quickly we can grow that. So we're growing that product right now. That's probably about a $25,000 product, but it can quickly go to $100,000 for that LRS product.
Great. We're near the end of our time. We want to thank you guys for a great presentation. With that, we'll get ready to set up for breakout rooms. For those in the audience, we'll assign you to a breakout room, or you can choose a breakout room to go to. I'll be in a breakout room for those who are interested in learning more about 10 Capital. Each of these other companies will be available to answer any of your questions. And typically these last for 10, 15, 20 minutes. They can go longer. At 5 o'clock, we do have to shut it down if you go longer. We can always make introductions. If you didn't vote on the polls, let us know. We're glad to make a follow-up introduction. With that, let's go ahead and thank everybody for a great presentation today. Great audience, great questions. With that, if you're ready, just jump into the breakout rooms and hope to see you there to talk more about it. And we'll be back next time for another presentation from 10 Capital. With that, we'll go to breakout.